our long call spread would be, we'd be losing on this trade. This trade would come down and this spread would be trading somewhere close to around $4 on this trade overall. So I put the trade on for $8.75. The market goes up, I sell, I'm out of the trade. The butterfly was trading for $3.40. But if the market goes down, and if I ever see this credit spread trading for $2.50 or around $2.25, I'm going to roll into that spread, and then I end up taking the net debit of this trade down. Let's say we sell it for $2.25. So $8.75 minus $2.25. That would be $6.50 overall. So that would end up being my max risk on the trade. And then I'm long a butterfly and I'm hoping that the market will bounce back. So I have two different options that I can do here. And if I had a platform, I would go in and just run it through the platform. But I have two different options on this spread. If I put this trade on and I start out in a butterfly, it costs me $3.40. I'm going to pay a lot more for the butterfly. If the market goes down and the market is going against me, this credit spread, this is my signal to trade. If I see this credit spread trading for around $2.50 or between $2 and $2.50, I'm going to sell that trade, and then I'm going to be into the butterfly, and I'm going to have a 15-point wide butterfly, and I'm going to reduce my risk. So instead of just getting out of this trade because the market went down and I'm paying, and I sell it and I close the position for $4 or $5, I'm going to adjust the trade, sell this net credit spread and try to bring in at least $2 to $2.50. And then I have a 15-point wide butterfly that I ended up paying $6 for. And that's my chip in a chair. If the market goes down and it goes against me, then on that trade, I'm okay. And I can still be in the position and have a chance for the market to bounce back and go towards my strike on my short butterfly at expiration. So the way that I really kind of look at this trade is that if I'm starting out in the long call spread and the market is, I start out in the long call spread on Monday. Hopefully Tuesday I can make it by. The market kind of stays the way that it is. When it gets to Wednesday, if the market has drifted about 0.5% lower, then I'm going to look to adjust that trade at that point in time. If I can adjust it on that day, now I'm into the height of time decay, especially in the S&P 500 index. So we have all the time decay on Wednesday, all the time decay on Thursday, and then on Friday it becomes a very interesting day if we get the markets to come back. If not, I've reduced my overall risk of the trade. I've taken a few dollars off the top. I added no more additional risk because all I did was roll into a butterfly, and hence the reason why I use the analogy you have a chip in a chair. Now, on the butterfly, I just want to get out of this trade at this point in time. I had 3 scenarios where I could make money. I had scenario 1 where I have the butterfly long spread on and the market doesn't move. My break even is 58.28. Market stays there at 58.34. I still did just fine on this long call spread. Market goes up. Well, that's simple. Just got to decide when I want to take it off. When is enough profit? Market goes down. I adjust the trade. I go in and I roll into this butterfly and I wait till this gets to a net credit of about half of it. And I really thought it was a lot more of a credit, but about half of it in this trade. So once that gets cut in half, then I come back in. I know what I did when I mixed the metaphors, but when it comes back in, then I would sell this and bring in a few more dollars and lower my risk, but still have a chance that the market can come back. And the wonderful thing about that is that a butterfly really wants time decay to be your friend. So you start on Monday when time decay, it obviously matters. It always matters in option trading. And if you're right on your forecast, you need some time decay to work, but your positive delta, every time it goes up, you're making money. Market stays where it's at. Time decay is your friend. You bought less time than you sold, so time decay can just work its way out. Market goes up and all of a sudden, or market starts going down and drifts down. One of the nice things about the index is very rarely are you going to have that gap down of 1 or 2%. You always have that a chance to adjust it. So you see this trading for about half of this net credit right now, about $2, $2.50. You take off a part of your risk. You add no more additional risk. The brokerage firm doesn't care that you're in a butterfly or a long call spread. There's no more additional risk. And you end up in that trade and you do, and you have this trade on now. Instead of $8.75, you have it on for $6.75. And that's the way you adjust the trade. Now, if the market doesn't come back, you still got to be prepared to lose this, right? Whatever you're in for, the net debit to the account of $6.75. It's not a perfect adjustment, but instead of just closing out your position, which so many people just don't seem to be able to do,